thank you everyone for coming to this webinar series, Capital Market Development in China and Asia. Today, we're very happy to have Professor Xiaoyan from Tsinghua University to present a fascinating paper on China's retail investors. And we're also extremely honored to have Professor ODEAN from UC Berkeley to discuss the paper. So as usual, Xiaoyan, you have 25 minutes to go. Yeah, please.
Let me start. I'm very happy and excited to present my paper on understanding retail investors, evidence from China. I said to the program committee saying, I would love to have Professor ODEAN to discuss this paper. And then, well, you know, our almighty committee made it happen. So I'm really, really happy. Okay, my co-authors are Charles Jones from Columbia, Donghui from Fudan University, and Xinran Zhang from Central University of Finance and Economics. Okay, first question, why retail investors? My discussant, Terry, and myself, he did a lot on retail investors, and I did a couple on retail investors in the United States. And you might wonder, okay, you have done so much about retail investors in the United States, why China? So let me give you the direct answer with this picture. Why Chinese retail investors? So in this picture, I'm showing the percentage of daily trading volume. I put all the investors on a major exchange into 7 buckets. And the first 5 on the left, those are retail investors. On the right, I have institutions and the corporations. What you can see is the highest bar is coming from retail investors with account balance between 500,000 and 3 million Chinese yuan. But if you put all 5 retail investor buckets together, you'll see that they account for over 80% of daily trading volume, meaning what? They are really important in everyday trading, and they play important roles in price discovery and liquidity provision. So that's, of course, you know, China is it's the second largest capital market in the world. You might wonder, you know, okay, so it seems like a local issue. Not really. China is growing, and the stability and the liquidity and the market efficiency in Chinese capital market will have influence on the global market as well. And our data, because it's coming from the exchange, we have very granular data. We can look at retail investors in different buckets and separate their behaviors. And also, I want to show you this. You might wonder, how come institution and the corporation, they don't count a lot? Well, they don't count a lot in trading volumes, but they account a lot in terms of shares they hold. So retail investors, are they important? Yes, with millions, hundreds of millions of retail investors active in the stock market every day, they are very important to understand for future regulations, for the market development. And also, you know, when we have the granular data, we can answer a lot of questions that cannot be answered before. That's the official reason of why do we look at Chinese retail investors, because they are important and China is an emerging market. What we observe in the United States where retail investors become marginal, they don't necessarily apply to China. Okay, so this is the official reason. Now, let me also talk about my personal attachment to this paper. 20 years ago, I was still a PhD student at Columbia. There was a debate within the country. That debate was very large. And basically the question is about investors in Chinese stock market. Are they investing or are they gambling? And for the capital market, is this a financing platform or is this a casino? And in terms of market efficiency, do we have transparency in information disclosure? Do we have enough liquidity? And at that point, I was in my 4th year of PhD study. I want to know the answers of these questions because I think they are the most important questions. So 5 years ago, I came back to China and I wrote a proposal to the exchange saying, I want to understand Chinese retail investors because this is one of the most important questions in Chinese stock market. And I was very fortunate that the exchange was very supportive, allowed me access to their proprietary database. And that's where we're standing. We have the data, and we only try to answer the most important and the fundamental questions of retail investors in Chinese stock market. To be exact, like I mentioned, Chinese retail investors, they count for 80% of daily trading volume, and they do a lot. Well, they contribute a lot to price discovery, right? How do they contribute to price discovery? Can they predict return? Do they know what they're doing? That's the first question. Second question is, if they trade one way or another, why do they trade this way? Is this about information? Is this about liquidity? Or is this about behavioral? And then finally, for every single stock market, you ask about liquidity. So the existence of retail investors, how do they contribute to the market-wide liquidity? Those are the questions. Very simple, seems like straightforward, too simple. And but they're very difficult to answer. Those are the questions we focus on in this study. And here I will be very brief on the literature. I only highlight my discussants paper because those are the most important ones. And no kidding, okay. Barbara and ODEAN has a series of papers establishing many basic facts of US retail investors. And most recently, Barbara, Huang, ODEAN, and Schwartz, 2021. Because this one I want to mention because during the pandemic period, there's a lot of attention on retail investors because people are staying at home. They do a lot of trading on Robinhood, which brings a lot of volatility to the market. So even in the United States, a lot of attention has been allocated to retail investors recently. We also have a bunch of Chinese retail investors literature, and I will not read through it because I only have 25 minutes. So what do we do in this paper? We have large coverage of the data. We want to do very thorough and a comprehensive job for understanding Chinese retail investors. And then I'm not going to read through this, you'll see it. But I do want to mention that this paper was finished last fall. So over the process, we heard a bunch of concerns I want to address up front. So when you hear the rest of the talk, you know where we're going. So people ask us, okay, now you have the data. Are your results descriptive? Are they summary statistics? Well, here are my answers. First, we do offer and provide important stylized facts for the major part of Chinese stock market. And second, we don't stop there. We provide thorough analysis of sources of return predictability and the liquidity provision. And there are also concerns about, do we already know about this in the United States? And the answer is, well, the US literature has been providing mixed results on many of our questions. And China, as an emerging market, the setup is quite different from the United States. We have the retail investors dominating in everyday trading, but in the United States, it's institution. So understanding current status of Chinese retail investors is important for both future academic studies and the regulators. Okay, so that's the motivation of the paper. Let me go directly to the data, and I'll be very brief on this. So we have account level data from major exchange. We have every single trade and every single account. So our sample period is from 2016 to 2019, very recent. And we have over 53 million accounts. Right now, I heard it's like over 100 million accounts in 2021. People are more enthusiastic nowadays. We put them into different categories, RT1 to 5, based on their account value, how much balance in their stock market, a stock account. And the number of accounts is decreasing. You can see that majority of those retail investors, they only have 100K. 100K, you know, in US dollars is like 10K US dollars. So it's really small account. But the large ones, RT5 has account size over 10 million. And we also have institution and the corporation in the data. In terms of importance of different groups of investors, here I want to show you the time series of the trend. The very top one, the green one, is RT3. Those are the very active traders of medium size of account. And at the bottom are corporations. They're long-term holders. They don't trade a lot. In the middle, the other retail groups are relatively stable, except this orange line of institution. I feel institutions in China, they are in a very peculiar position. They know a lot, but they don't drive trades majorly. You can see that sometimes they're going up, sometimes they're going down, but nowadays they're becoming more and more important. We measure retail order flows using a very commonly used variable called order imbalance. Basically, for every stock I on day D, we take buy minus sell over buy plus sell. The idea is we have the direction of the trades. I also put a very simple summary stat at the bottom. I want to make 3 points. Number one, if you look at the green part, well, grayish green part, you can see RT1 to RT4, they're positively and significantly correlated, by the way. So those are 4 smaller groups of investors. They tend to move together. Now the blue one, that's the RT5. They are the largest account holders from retail groups, and they tend to be moving the other direction of the smaller size of accounts. And we also have institution. Institution is moving against all retail groups. They're not the same. People wonder, RT5 are institutions, right? Maybe not, I cannot tell you. From their registration, they're not. But maybe some of them are pretending. Okay, 3 questions we want to answer in the next 10, 12 minutes. Okay, first question, can retail investors predict future returns? Our setup is very, very simple. We have return for firm I on day D, and we relate it to previous order imbalance. So we were hoping that if you know something about future price movement, you buy more, price go up. That means you buy in the right direction, right? So A1 should be positive. Now, if you don't know anything, or if you get it wrong, you buy more, the price go down, you lose money, right? In that case, A1 should be smaller than 0. And then if there's nothing between order imbalance and return, then there's, they have nothing, the A1 should be 0. We do our statistics very carefully. We use mu West standard error with 5 lags. Let's see our first result. For 1 day, short horizon prediction. So I only focus on RT1 and RT5. For the smaller investors, the prediction is negative 0.0093, highly significant with a t-stat of 25. What does that mean? That means if you put order imbalance measure in the cross-section for the RT1, you move from 25 percentile to 75 percentile of the distribution, your return is going down by 21 basis points next day. That is like 50% over a year, meaning RT1 probably is trading in the wrong direction. That is true for RT2, RT3, and RT4. They're all losing money. Well, they are not trading in the right direction. Whether they look money is another issue. Okay, but then we can see the negative coefficient is getting smaller and smaller. But RT5 is predicting return in the correct direction. If we move from 25 percentile to 75 percentile, that return difference is about 5 basis points per day. So it's 12% over a year. If you compare to institution, they make 10 basis points a day. By the way, you cannot really do this because the data is proprietary. You don't get to see it. All I'm saying is that hypothetically you can make money. Okay, so we see clearly across different groups, they have different predictive power for the future. Smaller ones predict return in the wrong way. Large ones predict return in the correct way. Now, if we extend the horizon to next 12 weeks, the idea is to see whether it goes away or reverse. And what you see over here for the red line, RT1, and for the blue line, RT5, the predictive pattern persists for 2, 3, 4, 5 weeks. So it's not quickly turning around. So I'll answer to the first question, 2 parts, both showing that retail investors with different account sizes, they have different understanding of future returns. The smaller ones get it wrong and the larger ones get it right. So this is a heterogeneity. Now the second question is, how come? Why do they trade this way? How come they have positive and negative predictive power for future returns? So we look at 4 types of hypotheses from previous literature. Not only we understand why we want to understand why they're doing it. First hypothesis is from Trolley and Subramanian. They're arguing this is driven by order flow persistence. If you continue to buy and buy and buy, high buying pressure will make the return go up, and then therefore leading to a positive coefficient. And we proxy this persistence by previous day order flow. And then there's Cuneo, Sarr, and Titman in 2008. They argue that, well, if you are contrarian, then you provide liquidity, you should be compensated. And if you're momentum, you demand liquidity, you should be punished. So we use a proxy from previous returns to identify liquidity provision hypothesis. And then a recent paper by Liu et al. Looks at survey data, and they find for Chinese retail investors, two biases stand up. One is overconfidence, and one is a gambling preference. We use the standard ways of constructing the proxies, like turnover and the max return. And then for the information story in Kelly and Tallock 2013, they're arguing that, well, they can predict return because they know something about the information. In their case, they look at earnings surprises. Now, I want to tell you, those are probably almost all, well, majority of the hypotheses I can find. We will be testing those hypotheses using the 2-step decomposition we introduced in our 2021 paper. So here I'm not going to talk about it, it's too technical. One thing I want to mention is for the 1, 2, 3 hypothesis, the first 3 hypotheses, they have data available all the time. We will be doing Pharma Macabas together. Now for the last piece, it's only there for earnings announcement period, so we can only do event study. Okay, let's see the result. First, let's see what leads to predictive pattern, or what determines order imbalance or retail order flows. Using previous day order imbalance, we can see all groups have order persistence or significant and positive. Now, in terms of whether they're momentum or contrarian, contrarian means the coefficient is negative. And if it's momentum, coefficient is positive. Positive coefficient means they demand immediate liquidity, and negative means the supply liquidity. You can see that RT1, 2, 3, those are 3 groups that demand immediate liquidity, but the other ones and the other horizons, they are providing liquidity. Now, in terms of the behavioral biases, one can see that RT1 to 4, they load positively on those behavioral biases, supporting the finding of the previous paper, but RT5, very peculiar, they have negative loading. Either they don't have the preference or they trade against those behavioral biases. Now, in terms of the positive and negative predictive pattern we find in return, here I separate them in blue and red fonts. Red means they contribute to negative predictive power, and the positive means they contribute positively to the predictive power. So for RT1, 2, 3, 4, persistence contribute to negative, meaning that they have been always wrong, continue to be wrong. And they demand liquidity, momentum at daily horizon, contribute to negative predictive power. Overconfidence and gamble, they are not helping, right? But if you look at RT5, everything is blue. So all 3 hypotheses contribute to their positive return prediction. Now I have the bottom one as other. What's other? That's the part cannot be explained by the 3 hypotheses. Let's look at the last hypothesis, public news. Kelly, Tallock, and our own paper, BJZZ says retail orders might contain firm level information. So we look at earnings announcement events for every single quarter and ask 3 questions. First, can retail investors anticipate future earnings surprise? Can they process already out contemporaneous news. And do their predictive pattern change on event days? I'm not going to show you numbers, I'll directly give you the answers. RT1 to RT4, they cannot anticipate or process contemporaneous or future earnings surprise, but RT5 and institution, they can. Now, the predictive pattern on event days, it becomes more negative for smaller retail investors and more positive for RT5 and institution. Meaning that the smaller ones, they really don't know how to, anticipate and process public news. Their disadvantage becomes even stronger on event days. But the larger ones, they are the opposite. Okay, at this point, we answer the second question and you start to think, well, RT1 to RT5, they don't know anything, they trade in the wrong direction. Maybe they're noise traders. Now, when I talk to the senior management at the regulatory agencies, they're saying, well, retail investors are really important because they help the liquidity. Well, that seems to be very consistent with Black 1986 in the sense that noise traders, they are important because they provide liquidity. And informed traders, if everybody are informed, then there will be no trades, right? So they are super important. That was done in 35 years ago. But most recently, Isaac, Seka, and Shen, GFQA publication says, retail provides liquidity during pandemic lockdown, which is consistent with Black. However, most recently, Eaton's paper says Robinhood investors, they actually reduce liquidity and increase volatility. So it's not clear whether retail investors are really providing liquidity. So what we do is very straightforward. We take the transaction cost measure, relative effective spread. We calculate that and we look at the activity of retail investors from previous day. And so if there are a lot of retail buying, does that increase or decrease transaction cost for the future? The answer is right here. So for RT1, when they have a lot of activity on the previous day, it is true. For the next day, effective spread is significantly less. Transaction cost becomes much lower. For RT5, if they trade a lot on the previous day, then the transaction cost becomes much higher and liquidity becomes worse. So this is consistent with, we have 3 papers up front, right? Black and set cost paper are consistent with RT1 to RT5, but then the RT1, 2, 3, 4, the noise, got it wrong. Black noise traders prediction are consistent with noise traders RT1 to RT4, as well as potentially informed trader RT5. So here we answered the last question. I'm not going to go through the robustness check. Here's the conclusion. We have account level data from January 2016 to 2019, we find significant heterogeneity. So retail investors, they are not all the same. We have hundreds of millions of them. They are important. The smaller ones, they buy and sell in the wrong direction. They cannot use public information. Professor Odin is like, I know that. They really can't, right? They cannot process. And they have behavioral biases and then they get hurt. And they follow daily momentum, demand immediate liquidity, but reduce future transaction cost. Now, for the large account size retail investor, they are opposite, so I'm not going to read it. What I care about is going back to this 20-year debate. Investors, are they investing or are they gambling in Chinese stock market? From our results, I think it should be clear to everybody here that we are seriously investing, but we do have some people gambling, right? It's a large group of retail investors. Now, capital market, is this a financing platform or is this a casino? I don't provide direct evidence on this, but to me, from what I saw over the past 5 years, we're trying very hard to make a capital market efficiently allocate resources. Now, for the last piece, market efficiency, information quality, public information, the quality is becoming better and better. The affect future return in the right direction and inform investors and more sophisticated investors, they can take advantage of it. And in terms of liquidity, Chinese stock market has been super liquid recently. What next? This is my last slide. What I heard in China is, number one, retail investors, they will continue to be an important part of the market. So the regulators are doing investor education. Hopefully they're, we at the PBCSF, we just did a launch of finance textbook for elementary school students and for college students. And then, okay, in terms of regulation, we restrict riskier trading for the smallest accounts. For instance, they cannot trade. Well, they have restrictions on trading derivatives and leverage trading. And then on the other hand, if we really want to help them to invest and protect their future downside risk, we should channel some of the investments into wealth products and the pension plans. And that's another thing on the list of regulators. And a lot of researchers are also working towards this direction. In terms of institutions, they account for 20% of the holding and 20% of daily trading. We observed for year 2020 and 2021, the fund industry has been growing like crazy, but which creates a new question. If you cannot choose stocks, can you choose funds? Professor Jun Pan provided some results on that. And now the information environment, we hope the institution can improve further on them. And we are welcoming foreign institutions to bring higher quality of investors into this market. That's all I have. Thank you very much.
Thank you so much, Xiaoyan, for the great presentation and almost perfect time control.
Yeah, I know.
Now, let me hand the audience over to Professor OD. Terry, the floor is yours. You have 25 minutes.
I was in pretty much just rolling along with your presentation until you said, are the Chinese, asked the question, the Chinese retail investors investing or gambling? And you said, well, the answer is obvious. And you said investing. I was sure you were going to say gambling. Because they're losing money and their turnover rate okay, so let's separate RT1 through RT4 and then RT5. RT5, that is less than 0.5%, less than half of 1% of the retail investors, and they have account sizes of over 10 million renminbi. Right? They're rich. This is a very small number of rich people. They might not be institutions, but they're not like you and me, and they're not the people that regulators are primarily tasked with protecting. So this, I view them as a different group. I find this really interesting. I love that part of the paper, but these are not the the individuals. They are the 0.5%, less than a half. Okay, the others, turnover rate for the other four groups is 3.4% a day. Okay, that's what, 800% a year, depending how many days the exchange is open. That looks very speculative to me. And as you've established, they're losing money. But that's just, it's my interpretation of the same. Oh, and I totally agreed with what your last slide, the need for investor education, maybe some protections, and more mutual funds, whether they're domestic or foreign. Somebody who went to business school and learned how to do a discounted cash flow analysis. You got to have a few people in the market who know how to do that, to sort of not keep prices efficient, but sort of keep pulling them back in that direction. All right, so let's see. Why are my slides not moving? Oh, now they're moving too fast. Isn't that the way? So my view, when I read this, was that this paper, which I'm calling JSZZ after its author's name, was modeled after BJZZ, the J, Z, and Z of which are co-authors on both papers. And the JS, let's see, Burma Jones Zhang is forthcoming in the Journal of Finance. I've read it many times. I started reading it. In fact, I'm going to quote it from 2017. I've watched that paper change over the years. Okay, and I think it's gotten better. So we're in agreement. So to a large extent, when I read this paper, I'd say, okay, the same three authors decided they got a hold of this great data from China. And they said, let's replicate our US paper using Chinese data. We have Chinese investors. Better yet, we have some partitions by account size. And we've got all the trades at the exchange. And we don't have to go through a rather, it's not super complicated, but an imperfect method of signing trades. The problem was the main results don't replicate. It's just not there. And I think actually that both papers are empirically correct. So that's not the issue. It's just what they thought they were going to find, it wasn't there. And I'll get to that in a moment. And here they run the same two-stage regression as in BJZZ to try to understand. And that what the thing is, BJZZ ran a regression to try to understand why retail order imbalance was positively predicting returns. They're trying to say, how is it that these retail investors that, you know, Brad Barber and Terry O'Dean have been telling us for years lose money? How is it that they're making money? And it made sense to run that regression. And, you know, I have different interpretations of some of the results, but I'm not disagreeing with the empirical results. In this case, it didn't make as much sense to run the regression, at least not for the same motivation, because the retail investors in this study are losing money over these short horizons. You don't need a special investigative unit to figure out how they're losing money. And so that made the two-stage regression a bit awkward. For example, you guys write that order persistence contributes to the negative predictive power of smaller retail investors. It's not clear why order persistence should lead to negative returns. The whole argument in the earlier paper is that if order imbalance was persistent, that would create price pressure the following day, and that would lead to the positive predictive returns. I have a paper with Brad Barber and Ning Zhu from, I forget, like 2006 or something, 2008, where we looked at the same thing on a weekly basis and made the same argument that positive correlation in order imbalance led to positive order imbalance predicting returns. The problem here is it's in the wrong direction. So the two-stage decomposition, and I'm hope, you know, you didn't explain it, and you're right, it's too technical, and I apologize to the readers who don't understand, you know, haven't had a chance to read the paper yet, but you should read the paper. Persistence. So the idea here is that order imbalance, if it persists from day to day for retail investors, that will create price pressure in the same direction. If people are on the buy side of the market one day, they're likely to be on the buy side the next day, and that's going to create positive price pressure and push the prices up, so predict positively. The problem is both the first stage and the second stage signs are wrong. So it goes the opposite way of the BJZZ. Liquidity provision. The idea here is that retail investors provide liquidity for institutional investors who are in a hurry to trade. And as a result, and they do that by being contrarian in the sense that if the market is going up, they sell. If it's going down, they buy. And they get rewarded for that by having the prices move in the direction of their trades the following day. Both signs are wrong here. This, you know, it's not what's going on. Personally, I never liked this hypothesis, so I was kind of happy to see it knocked down in both directions. The next one is liquidity demanding. Now, this felt a little ad hoc because you guys don't even cite anyone who says, oh, you talk, well, okay, no. I apologize. That's not quite right. But you talk about one-day momentum strategies. And I don't think anyone's written about one-day momentum strategies, but I could be wrong. It just felt like, okay, it didn't work the way we thought it was going to work, so let's flip the sign and come up with a story. I actually think this story is right, so I don't mean to be too harsh here. My favorite liquidity demanding story is an attention one. And that would say that the stock grabs the attention of a bunch of investors, that causes them to buy it, and that pushes the price up. And then you get the reversal subsequently. And that's what we find in our Robinhood paper, which is contemporary study. So the sign of both the first and second stage regression match this story. And I was happy to see that because that's the story I've been telling in recent papers. Okay. You have a couple of other stories here. And let me just briefly say why I don't think you get your proxies lined up, even though the proxies themselves are interesting. You use turnover as a proxy for overconfidence. Now, and you cite Brad and me and the Lear survey paper. Now, both of these papers argue that more overconfident investors will trade more. The Lear paper does it with a survey. They survey people as their motive, and they say that people who think they know more trade more. And I've done a bunch of papers. We looked at gender, we look at other things, but neither of these papers, I don't know anywhere that says that overconfident traders. What we find is overconfident traders have higher portfolio turnover, not that there is time-varying investor overconfidence about specific stock that causes the cross-sectional difference in stock level turnover. Again, I actually think turnover is a better proxy for attention. And in fact, Brad and I used turnover as a proxy for attention in the first paper that we wrote about attention. And I realize in your paper, turnover doesn't end up working, but I don't think it's sort of for overconfidence. And large price moves, well, large price moves could attract gamblers, I agree, but there are other things about large price moves that might be affecting markets. So it's not a great proxy because it could proxy for different things. Kosman and Freyan have a recent paper that just looks at large price moves over the last month, and it doesn't mention gambling once, forthcoming in JFE. And as I say, we previously used large price moves as a proxy for attention. So I'd at least consider, I do think that part of what is going on is price pressure over these one-day, this one-day phenomenon where a bunch of retail investors who are not doing discounted cash flow analysis get excited about the same stock at the same time. They drive the price up. They're all paying attention to the same stock, and then it comes back down. And that is, what we see in our Robinhood paper. Now, some history. I have a few minutes left. Okay, some history of what's going on here. So persistent in cross-sectional order balance. Chorty and Subramaniam wrote a paper about this in 2004. They used ISSM and TAC data, transaction level data in the US, and they looked at all orders, basically all market orders. So they weren't looking at individual investors. They were just saying that in the market at large, there's persistence in the direction of basically the direction of orders that demand liquidity, market orders, and that persistence could lead to order imbalance predicting returns. Brad, Barbara, Ningzhu, and I looked at the same issue with monthly retail brokerage data. So we had actual trades, and then we came back and looked at it using the tech data on a weekly basis, and Soren Hidyar wrote a contemporaneous paper doing almost the same thing, looking at monthly data. And again, we found persistence in order. We found persistence in order flow, and that short-term order flow, order imbalance. I mean, persistence and order imbalance in that predicted returns. And BJZZ find this at the weekly level. The contrarian literature, it tells the story I said before. It says that maybe retail investors are making money because they're contrarians and they buy when institutions want to sell, and they sell when institutions want to buy. And because the institutions are in a hurry, the contrarian investors get rewarded for providing liquidity. Keneal, Czar, and Titman uses NYSE consolidated audit trail, and found that there was this persistence in order flow, and that it and there was this positive prediction in terms of order imbalance and returns. Barreau, Keneal, and Zer look at French data weekly. They find the same thing, and then BJZZ find the same result, and this is one of the explanations that you guys in that paper sort of explore. And then, and one of the curious things about this story is that two of these three papers, certainly the BJZZ paper. The BJZZ paper is looking at market orders. So you're basically saying that the retail investors supplying liquidity with market orders, which is not out of the question, but it's not the natural thing you would think usually. Okay, and finally, the idea that individuals may be informed, Kelly and Tetlock bring it up as a possibility. They tread lightly. They never actually in their paper, they just say the order imbalance predicts future returns, which is possibly consistent with informed investors. BJZZ started off pretty enthusiastic back in 2017. You wrote, we find that retail investors are informed at horizons of up to 12 weeks. Retail investors are quite well informed as a group. Now you backed off of that. As I say, I think it's a much better paper that's getting published, and everybody gets, that's why we do revisions and we present papers. Now you say consistent with the hypothesis that marketable retail order flow contains valuable information about future returns. That's pretty watered down and probably correct. All right. So these stories, there's a history to all of these stories. I want to tell you, I've got a working paper that I think is relevant and sort of reconciles your two papers in a way. So order imbalance, the studies, the basic analysis is that you sort stocks into groups, let's say 5 quintiles based on retail order imbalance, the same, the formula that Xinyuan put up earlier, buys minus sells over buys plus sells. And then you form a long short portfolio where you go long the stocks that retail investors are buying and you go short the ones they're selling. And in the BJZZ paper, you find, and several of these, all the papers on the previous page, all the papers on the previous page find that that long short portfolio makes money. You guys find it, yours loses money. So in my paper, it loses money too. And it's using the US data, and it's using the US data, the same US data as in BJZZ, using the same methodology. And here's why. In the order imbalance studies, you equally weight every stock in the quintile, or you can value weight it. Usually the results are strongest if you equally weight it. That's what I've got in the blue bar or the blue line there. And that strategy is making about 10 basis points over 5 days. The red line, I'm weighting the stocks in the top order imbalance quintile by the dollar volume of purchases of retail investors. So we're weighting it, we're weighting it by what the retail investors are going to make or lose. And the negative order imbalance quintile we are weighting the stocks in the short end, that's the short end of the strategy, by how much the retail investors were selling them, and they lose money. And this paper is all basically reconciling that the retail investors, there is a way to weight their order imbalance that predicts returns, but the investors themselves are losing money on these trades. The reason they lose money is they trade the stocks they trade most actively lose money, even though the stocks they're trading less actively seem to be making money or positively predictive. I think what's probably going on in China is you just have a lot of really active traders. You're just finding that second part that we get. By the way, we do something similar to what you do. You've got better data. There's no doubt about it. But you have account size. We don't have account size, so we break up trades based on the size of the trade. And here I'm graphing the losses, the trading losses over 1 day and 5 days to these groups based on the size of the trade. And it's a lot like what you get when you do that same analysis for the size of the account. And we go to our discount brokerage data, and we show that, at least in the US discount brokerage data, the size of a trade positively correlates with account size. Also, it correlates with experience and education and income. So, we'll get to the conclusion, but that's where we're heading. Now, why do individual investors lose money from trading? One reason is basically asymmetric information, and no doubt this is a big part of it. Basically, institutions know more than the individuals. The individuals are either overconfident, in other words, they think they know more than they do, so they trade anyhow. It'd be like me going out and challenging a basketball player to a game of one-on-one, not because I thought it would be fun to play, but because I think I'm going to beat the person. I'm not. Or they're trading for entertainment. They're saying, yeah, I lose a little money, but it's fun. And that's fair. We did a study with Brad and Jane Liu and Lee, and we on Taiwanese data, and we looked at every investor in Taiwan, and we found that this was not the point of the paper, but one small point in the paper was that when Taiwan instituted a national lottery, trading volume dropped about 20% on the exchange. So clearly there are people who are getting entertainment and gambling. Another reason individuals lose money is transactions costs. And you see this over time. You see the losses through transactions costs changing. In the 90s, that was a big loss to retail investors. Commissions were higher, spreads were higher. Now that's starting to become a smaller consideration. And finally, and what I think is interesting, and you guys might be able to explore this more because the data is so, it's like great data, which is that I think retail investors lose money because of mispricings that they themselves create. And they drive prices up because they get excited about things, and a bunch of them buy at the top and lose money. Again, that's what we see in the Robinhood data. I'm not saying every single investor loses money, certainly not, but that in our study, on average, the Robinhood investors lost money during these herding events. Finally, as you pointed out, individual investors are heterogeneous. One big thing that in your paper and the paper I'm writing right now and other papers I've written, other people have written, and this is all say that less wealthy, less educated, less experienced investors earn lower returns. This is important. So again, when you say, well, some of the retail investors made money, some lost. Let's see, what were the numbers? It was 53,488,880, I think, lost money, and a little under a quarter of a million made money. If I were a regulator, I'd be worried about the 53 million. I'm just saying, the others are a different sort of animal. And it's interesting, maybe they have inside information. Certainly some people have inside information in the market, and some ordinary retail investors probably have it, and it gets lost in because so many don't. Other things, investors who trade more actively earn lower returns. You show that here. Again, the turnover was much higher for the 1 through 4 group. It's lower for the daily, the group 5, and lower for institutions. I found this in other papers. And again, I think it's important for regulators at least to be thinking about this. I'm not pushing a particular regulation. I'm just saying, but realize this is the trade-off here. You have people who, if it's their retirement money, that might not be so good. If it's their play money, that's fine. Order type. Do you guys, I couldn't tell from the paper whether you can identify market or marketable orders separately from limit orders. No, okay. Well, scratch that. I mean, there are differences, but I had some ideas. I would have been curious, but that's fine. And then cross-country differences matter. And that's why I agree with you completely. You can't just say, oh, somebody looked at this in the US, so we know the answer. There's no way. A lot of detailed data has come out of Finland and Sweden and Norway, and it's fabulous data. But there is a world of difference between the investors in Finland and the investors in China, Taiwan, India, and Korea. Turnover rates are dramatically different. The US is kind of in between. There's also a big difference in the US and China in terms of the fraction of trading by the individual investors you pointed out. In the US, most trading is institutional. If I'm a US investor and I place a trade on Robinhood, well, we know who's clearing that trade. It's getting bought by a wholesaler, and then probably some institution is picking me off. In China, you are probably trading with another individual just because of the numbers. And then countries vary in their trading costs, and that varies over time series.
Sorry, yeah, that's perfect. Okay, just about to say
that was my last slide.
Well, perfect. Well, thanks so much, Terry, for the stimulating discussions. Xiaoyan, would you like to respond to some of the comments first?
Give me 30 seconds. First of all, congratulations on the JF forthcoming. I will change the citation. Second of all, we actually did losses and gains for every single account. And it's not in the paper because the data is considered confidential. So that's taken out. But I do know the answer to your question: who make money, who lose money, why do they lose money? Okay, so they're mostly, you're right, they cannot time the market. We follow your approach. They cannot time the market, they don't know how to select stocks, and they trade too much. But in terms of how much they lose, for the 53 million of those accounts, they're not losing a lot. It's more like they're paying for entertainment, not a lot. Yeah. Not a lot. Yeah. I fully agree with you. Now, last piece is for all your suggestions at the beginning, I think we didn't write very well. I think I can explain, but I'm not going to take everybody's time. But I really appreciate for your review of our history and put that into perspective of the whole literature. We'll do a little better in writing in the future. Thank you.
Great.
Thank you. By the way, I just had one other comment, which is, I think it's very interesting. We've also been looking at, I got asked by a journalist 2 days ago, how much do individuals lose by trading? And I said, I don't know the answer. Actually said, I know someone who knows the answer in China, but the guy was writing about the US. But I said, it's a lot less than they were losing two decades ago. Yeah. It has changed a lot. We did the study in Taiwan in the late
2% of GDP.
Yeah, and the losses were and the losses were huge, but it was transactions costs were really significant. So I agree with you they're probably, I mean, you know, I have to agree with you. You've got the numbers, I don't. But I would expect that the losses are not humongous. So you could say, well, you know, it's cheaper than going to Las Vegas or Macau.
Well, yeah, but we still hope they can be more rational towards their wealth, right?
Yes.
So
And it would be better for the market because you got too many people swinging that market around who don't. Yeah.
Yeah. Thank you.
Okay, let's open the floor for discussion. For those of you who are sitting on the panel, just speak up for yourselves, and for those in the audience, feel free to type your question in the Q&A. I will read it for you. Bernie.
Oh, hi, me. Well, thank you for giving me the opportunity, and I really enjoyed the paper and the discussions. It's a very positive learning experience. Thank you. I have something that I'm curious about. Number one, is along the line of the laws. You have RT 1, 2, 3, 4. I want to know, you know, the entry and exit rate of these people, and I want to know if you can divide them into age brackets and education brackets to see how much they lose. If I were a policymaker in China, the thing that I'm most concerned about would be the retirees. In the Chinese term, we call them big uncle and big auntie, you know, that they sit in front of the exchange and lose a lot of their retirement money. So that's why I'm interested to know the entry and exit and which age bracket, what they lose, and in which geographic region. This is really for my takes on the welfare implication. The second thing is that is a smaller question. I'm interested in, you have a point about the retail orders predict the future returns. So if that's the case, if I'm RT5, I'm going to time my trade after I've observed the pattern in the day. So do you observe something on the clustering of trade by the RT5 at which time of the day? I won't trade, I will mark my trade in such a way that I know that, okay, these people are informed, but they provide me information and I know I'm going to act now. So would that be possible?
Mm-hmm. Can I answer, Michael?
Yeah, sure.
Okay, so Bernie, thank you for asking those questions. I'm going to share with you what I have here to answer your question. So you ask, do you see it? Bernie, do you see my slide?
Yes.
Yes. So what you can see here is, let me make it bigger. Okay, the pink ones are female. The blue ones are guys. Okay, and then I have age groups. So 35, you know, basically guys always not doing so well. And the women, sometimes they do so well. Okay, so but Terry already know that guys are too confident. But then your question about, you know, can I separate and calculate the loss and gains for different age group, education, wealth, so on and so forth? Yes, we can. And I just am not so sure that can be published. I can still, for policy making, that would be very relevant for the regulators. So originally, we take it off from the paper, but you're right. We still need to write that report for regulators because it's very meaningful for the pension, for protecting people's wealth. And the second thing is,
May I interrupt you on that one, Xiaoyan?
Yeah.
If I'm thinking about this, if I were the regulators, I'll think about how much do they lose before they exit. If I have 100,000, I lose 5,000 and exit. It's very different than I have 100,000 and I lose 90,000 before I exit. You know what I mean? So that kind of information is very important for us who care about the noise traders, the retail traders, the overconfident and whatnot, undereducated, and they lose too much. I want to know how much they lose, when they will stop.
Yeah, we should be able to see that. I just have to go to exchange and and write them internal reports. They probably would not allow that to be published. It's going to be confidential. But then I do think those are very important questions. And then in terms of timing of the trade, this is related to some of my other projects working on dynamic information of trades over the day. So yes, I can time the trades and I can see the account. That one we can definitely do. Right now we haven't done that because this is one of the few papers I have in my mind. So that can be done. Thank you for raising the issue.
Something related to it, not perfectly, but I have a paper where we look at day traders in Taiwan, and we find that, and we look at exit and entry. We're basically, well, exit. And what we find is that people who've been losing money are more likely, but only slightly more likely to stop day trading. Now, most of the losses are not of the magnet. It's not like somebody started with 100,000 and ended up with 5,000. So I think the losses are smaller but persistent, kind of along the lines of a sustainable gambling habit. Again, you know, where you see, we'll see people who every year are consistently losing some money, but you know, they have days where they make money, they have days where they lose money. On average, they lose money and they keep trading. So I would expect that you wouldn't see a lot of exit because of small losses. You know, people who take a real hit might exit. And that's both consistent with people learning slowly or just doing this for entertainment and paying the price.
The thing that I'm very concerned about is that gambling can be addictive. And you gamble and gamble,
Absolutely.
you lose a lot of money, then you have no money for retirement.
I agree completely. I mean, it's kind of, you know, I talk to my students about this. I talk to them about trading as gambling, credit cards, and different habits that work for. So many people here in the US drink a little wine at dinner and don't have a problem with alcoholism, but a certain percentage of the population ends up with a big problem. I think the same thing, somewhat analogously, that for some people, the gambling in the market could become addictive and materially expensive, not like a cheap pastime, but something that, you know, kept food off their plate or made it hard to pay the rent.
Thanks. So, Bing, you have a question.
Can you hear me?
Yes.
Okay. So I'm really fascinated by the well-known phenomenon of like crazy trading by the Chinese retail investors. And your sample period covers a very recent time period, right? So actually, like in the middle of 2015, that was the start of one of the biggest stock market crashes. And also during this time period, we did see the rise of social media on a massive level for investors in China. So I just wonder, maybe I'm giving you a data you have, right? So that may be quite interesting to look at whether the crazy trading could be partially facilitated by social media.
Totally. We have another paper on Reddit and Robinhood and all the crazy things earlier this year. But for the Chinese data set, for social media, yeah, we haven't done that. I have to be honest with you. But then I think Guba and Snowball, they all have those, you know, crazy social media activities. We can connect them to the over trading by retail investors and the gambling preferences. Yes, I think we can do that, but we haven't done that. Thank you.
Yeah, actually, let me ask a question, you know, from a different perspective. The paper is very convincing, for sure. But, you know, I'm completely outside the literature. I would like to think a little bit differently about the basic pattern. Say that, you know, you see a lot of small investors. Well, you see some accounts have small size, but it doesn't really mean the investors, who own the accounts, they are poor, they are trivial. It could be a kind of reflection of some optimal portfolio choices. Say, it's related to Terrance's comment. Say that I didn't know that, it was a big response to Taiwanese gambling. So that's fascinating. But
yeah, that was cool.
It itself is a reflection of some optimal portfolio choice. Some big investors, if they don't have other choices, for instance, in the case of China, where you see a lot of financial repressions, many investors do not have many choices for risky investment. So they may actually end up in this situation. So then the welfare implication will be quite different. So I would like to hear your thoughts on that. That's also related to cross-country comparison that Terry raised at the end of his discussion.
I think this is one project that the stock exchange is trying to do, like Michael, you said. People from econ side, they tend to think, okay, so the investment in stock market is only a small part of the wealth, right? So people from Southeast, okay, Xinran 财大, you know which one I'm talking about. And then they have the household finance data. They are trying to connect that with the exchange data set to figure out, is this a big chunk of their wealth? But so far, well, that's a project undergoing with the exchange. But then if they finish that one, you would have an answer, Michael. But that would be from Xinran.
Okay. Look forward to that.
Yeah, it's not going to be the big sample because the data from the exchange and data from the censor, the Bureau of Statistics, they're not connected yet. So it's going to be a small sample, but still it's going to offer you some answers.
Yeah. So we still have 2 more questions from the audience. Yeah. I'm not so sure if you can read it yourself.
Yeah, I can read it. So the first question is intermittent reinforcement, meaning that individuals earn money sometimes, lose money over time. If someone loses money on 90% of their trades versus somebody loses 50%, is there a way to quantify both number of trades for intermittent reinforcement to work? The answer is yes, as long as we have the permission from the exchange to use per trade data per account. Yes, we can do that. And the second question is, ODEAN mentioned about Taiwan and the drop of 20% in trading. Which year was this observed? I think it was 2000s, right, Terry? No, you need to unmute yourself. It was a very cool paper.
Thank you. Our data was, I think, 1995 through 1999.
That was a shocking paper. Like they lost 2.5% of annual GDP by trading too much, and they connect to lottery opening in Taiwan and then compare about their losses. It seems like a lot of people take this as lottery.
I presented that at the Taiwan's regulatory agency, and as I was walking out, a young woman chased me and said, Professor, the commissioner wants to know if you plan to publish this in Taiwan. And I said, oh no, we're going to publish it in the US. And she said, oh, he will be very happy. And I was thinking about, it sounds like the exchange is being a little bit more careful in terms of asking you what you plan to do before they give you permission to do it. Because
Terry, there's an interesting thing. At one point in time, Taiwan, when Ma Ying-jeou was in charge, was elected, then the finance secretary imposed a capital gain tax. Did that discourage this kind of trading? For a very short period of time, and then she quit afterwards.
Yeah, Bernie, that's a very nice question. Whether should we impose?
I mean, because like the lottery district put the gambling money another way.
Mhm.
But this transactions cost, this capital gain is really a transactions cost. Does it reduce the kind of irrational, the noise trading?
So do you have any idea about what year that the
I'll
events
dig it
took
up for
place?
you. I'll dig it up for you.
Okay.
That was
'cause-
when the year that Ma Ying-jeou
2010?
was elected, and then it was 2000.
10?
You have to minus current time by 12. So it's
2010, right?
yeah. I'll dig it up for you.
Okay.
Yeah, because the Minister of Finance announced that she was going to do capital gain tax, etc., etc. Let me dig up the information and send it to you.
Okay.
Maybe someone else knows,
Yeah.
but I'm an old man. My memory is not too good.
All right. Since we have run out of time. Oh,
The lottery
please, go
was
ahead.
January of 2002. That's when the lottery was introduced.
Yeah, my
And I'd be
question
very,
is-
yeah.
yeah.
So since we have run out of time, we have to stop this very stimulating discussion. Unfortunately, I certainly, enjoyed a lot this webinar and learned a lot from it. Bernie, do you want to give a concluding remark?
I think we're already running over time, and it's so well done that I don't think I need any conclusion. However, I would like to announce that on October 28th, we will have another paper, FinTech as Finance Liberator, by Xiang Wei. And I look forward to listening to the paper and the discussions. I want to welcome the participants to come back. And let me thank Michael, Xiaoyan, and Terry, really, and all the audience. This is a wonderful, stimulating seminar. I learned a lot. Thank you very much.
Thank you.
Thank you, everybody.
Thank you.